maybe first, before we kick off the conversation with Michael, I just want to remind people that MicroCapClub's doing a physical event collaboration with Bobby Kraft and Planet MicroCap. That event's going to be April 22nd to the 24th in Las Vegas. As many as online communities are great. Substacks are great. Reddit's, I guess, can be great. But there's nothing better than meeting physically in person with other investors and other management teams. And so we already have 250 investors signed up already for this event in April. It's not just for the MicroCap Club. It's for anybody that's a MicroCap investor. It's free to attend. There are some perks for MicroCap Club community folks. But again, if you're a MicroCap investor, this is a place you're going to want to be. Don't miss the event. Planet MicroCap, Las Vegas, April 22nd to the 24th. A quick disclaimer before we get started. The purpose of this conversation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. MicroCap Club is not a registered investment advisor. MicroCap Club, its partners, members, subscribers, affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. And also as a reminder, as this conversation kind of starts and in the middle of it and towards the end, if you have any questions, you can ask a question by clicking the Q&A button on the bottom of your Zoom screen. You can enter them there and we'll try to get to them, during or right after the conversation. I want to thank everyone for tuning into this conversation with Michael Melby. Michael's been a member of the club since 2015. He's the founder and portfolio manager at Gate City Capital Management. Gate City has, quite honestly, an incredible long-term track record of outperformance, generating 22.4% net annualized returns since inception, which is September of 2011. And that's versus 14.8% of the S&P. Again, incredible performance. And I think what makes Gate City unique is they didn't beat the market by owning tech stocks, by owning NVIDIA or the Mag 7 or any types of stocks like that. In fact, their flavor of investing is the unloved factor of deep value. And deep value has been a factor that's been out of favor, I think, for probably over a decade. And yet Michael Melby and his team at Gate City has not only beat the markets, but you could say they've trounced it. And I think they've only had one down year out of 13 years, and that was down single digits. So again, it's incredible performance and outsized returns in a factor that has been unloved and underperforming for a long time, where most other people are underperforming the markets. And so with that intro out of the way, Michael, thanks for joining us today.
Hey, Ian, thank you very much for the kind words. It's great to be here and really appreciate the opportunity to chat. So thanks for having me. And I'll repeat the disclaimer from our side as well. No investment advice here and do your own work, but excited to talk about our process and the team and maybe some ideas later on as well. So thanks again for having me.
Sure. And, I was looking forward to this conversation from a variety of levels, one from kind of an investor level, kind of diving into your strategy, even as an emerging fund manager, kind of a couple questions kind of on that, as well as you've scaled up the firm. But maybe a good place to start is really kind of from the beginning. You've come from Eastern Montana in a small town called Glendive. I think the population's around 5,000 people. It's I think a known agricultural or ranching area. I think you even have the Yellowstone River flowing right through it. And I think for a lot of folks, when they think of the Midwest, they think of, the show Yellowstone, and they probably think that, you were raised on a cattle ranch and were in bar fights in the evenings. But that's probably wasn't reality. So I'm just curious, like, what was your upbringing like, there in Glendive? What did you do? What did your parents do? Were you a sports guy? Were you more academically minded, in high school? Tell us about you.
Yeah, thanks. Yeah, I had a really fortunate upbringing. As you said, grew up in Glendive, Montana, which is about a town of 5,000 people in eastern Montana. So unlike Yellowstone, it's kind of a flat Badlands type area, much more like North Dakota in terms of geography than western Montana. But yeah, and Glendive, Montana is nicknamed the Gate City. And so our logo and the name of the firm paid tribute to where I grew up. And we're now in Chicago, Illinois. So it's a little confusing for some, but Montana tends to have positive connotation throughout the U.S. So, yeah, I grew up kind of in town. My parents were both high school teachers. My dad taught high school business, and my mom taught English. And so kind of academics was focused on in our household. Initially was interested in investing. My dad taught a general business course, and each semester he would have his students pick a stock and then compare it to a stock he picked by throwing a dart at the Wall Street Journal, and then would take the winner out to lunch or something like that, and maybe side wagers along the way. So kind of got initially my interest in investing through my father. Yeah, in terms of growing up, kind of a combination of academics and athletics. I played some tennis and some football and was okay in tennis for Montana, but a pretty small sample set when you think about the US or the rest of the world. But enjoyed kind of the outdoor life there as well, like reading, and kind of gravitated towards math too in my studies. So from an investing standpoint, after high school, I went to Notre Dame and majored in finance with the goal of being an equity investor at some point in time. And I thought that combined kind of my nature in or my interest in math and kind of the quantitative side of finance with kind of the business side of running a business and operations and allocating capital. So majored in finance at Notre Dame after school, went to work for Deutsche Bank in their debt capital markets group in New York. Covered a lot of companies, primarily investment grade companies. And through that, I guess, was able to expand my level of knowledge, especially in fixed income and derivatives. And Gate City is long only. We don't short anything. We don't use any leverage. And we also have an aversion to debt. And I think part of that aversion came from my time at Deutsche Bank. I left there in 2007, and it was just prior to the global financial crisis, and really got to experience and see the dangers of debt and leverage, as a lot of the very aggressively priced debt instruments turned out to be a very poor investment for a lot of global investors, and those problems were only compounded by the amount of leverage either explicitly or implicitly placed on a lot of those instruments, and unwinding those proved to be very, very painful. After Deutsche Bank, went to work for the Notre Dame Investment Office in their endowment office, and focused there on risk management, natural resources, and fixed income. And so we were an outsourced model there, and through my time at Notre Dame was able to interview and get to know a lot of alternative asset managers, and really work and interact with some of the best investors in my view in the world. And through
that was during the GFC too, wasn't it? Like during that 2008, 9, 10 time period. Is that correct?
Exactly. And it was a very challenging time for a lot of them from an investing standpoint, and a lot of endowments. It was a good opportunity to invest, but I think something that kind of impacted everyone was there was a lot of capital that would like to be deployed, but through commitments and other things, it made liquidity much more of an issue for a lot of endowments. And so I think Notre Dame was very well prepared for that, but it was very interesting watching from the institutional side just how that process played out in an environment where liquidity really dried up globally. And then I left to pursue my MBA at the University of Chicago. Graduated in 2011, and after that formed the entity, which is Gate City Capital Partners. Started a microcap focused portfolio from 2011 through 2014. It was just my own capital, And then in 2014, launched Gate City Capital to outside investors. Initially, I founded the fund with $150,000, then it grown to around $300,000 in 2014, and did the official launch with maybe $550,000 in assets under management. And yeah, over time, I guess through today, we've had some nice growth, both through performance, and then have been able to attract some additional capital as well. We're just over $200 million in AUM today. And yeah, just going back to kind of the firm's focus, we manage a concentrated portfolio focused on micro-cap value companies, target 15 companies in the portfolio, look to have a 2+ year time horizon when we make an investment, and have, I guess, a couple parts of our investment process. We tend to look for companies with little or no leverage. If a company does have debt, we want them to have both the willingness and ability to pay it off. We tend to focus on companies that have some sort of real asset component. Most of our companies own either things like land or buildings or other real assets that are very difficult to replace. And I think a long-term concern for me has been inflation. And have always liked owning a portfolio of companies that own actual things that can't be printed by central banks or other entities. So that's been a focus, and I think that's also a big part as we think about downside risk. And certainly during periods of market dislocations, the secondary value of things like real estate you might not have a bid for. And but by thinking long term, it's my view that often in those situations, those assets retain their value as long as you don't have any liquidity restraints between now and when markets normalize. And we also make a point to meet management teams in person before making an investment. And so do a lot of traveling and try to get to know management teams and really evaluate them on three main criterias. And that's their intelligence, their integrity, and their work ethic. And have found when those are in good alignment that good results tend to come from that. So one additional thing we do is a part of that, we try to go to annual meetings whenever possible. They've increasingly gone virtual as we've come out of the pandemic. But I found that it's a really great opportunity both to showcase our interest in being long-term partners and investors in the companies we invest in. But it also has given us the opportunity to meet with not just maybe the CEO or CFO, but many members of the management team and also a lot of board members. And it's been interesting to see how those connections have both expanded and kind of intertwined as we've gone through the years. So that's kind of at a high level how I got started, how the firm got started, and a little bit on who we are today as well.
Thanks for that. It's a pretty incredible story, starting out with $300,000 and seeing the success that you've had over the last 10 years or so. It's pretty incredible. When did you, kind of looking back, like when did you know that you wanted to launch a fund?
Yeah, it's been a long-term goal, and I guess out of business school, had planned to move forward with it at that time. Right after kind of forming the partnership, I was approached by a firm called Crystal Rock Capital, a long-only equity firm out of Chicago, and worked at Crystal Rock for about 3 years after graduation as an equity research analyst. And through my time there, was able to save up enough money where I thought from an expense standpoint, I could both manage my own personal finances and manage the firm's finances for a period of 3 years without raising any additional money. And what kind of my goals were there was to take away any outside pressure on having to raise money, especially from groups or that might not be the best long-term investment partners for Gate City. And I think the other important part of that, and kind of what I tell other people who are interested in starting a firm, is in addition to being comfortable with the financial aspect, and that can come a number of ways, but it tends to be a financial situation for individuals that is much more volatile than what you would see with a normal salary and job. And not only does your compensation change with the performance of your firm, but also your underlying equity investment within the firm changes as well. So it's to take as much pressure off yourself as possible when thinking about short-term performance, I thought was very helpful. And I encourage people, I wasn't married at the time, but I encourage people to share these decisions and thought processes with your spouse and significant other, and really take family into consideration as well as you think about having the right opportunity to really focus on it and have everyone within your family and also all your investors on the same team. And it's a lot of work and sacrifice. The other aspect, I think it might, I don't want it to sound conceited in any way, but I think an individual needs to have confidence that the investment product that they are offering is one of the best alternatives that they would recommend for their friends, family, and potential investors, and to have that conviction in yourself that what you're offering to your investors is better than almost everything else out there. And to pose it a different way is, why would you start a firm if that wasn't the case? And it's very difficult to go to your friends and family and other people who are important to you and ask them to commit capital if you don't have that conviction in what you are offering. So when I launched it, I had the conviction that by focusing on microcap value, being long-term, protecting the downside, and doing a lot of on-the-ground research, that this was a subset of the market where I and Gate City could have a competitive advantage, and it's also something that I wanted to do for the long term. So that's kind of the combination of why I thought it was the right time, both having the financial wherewithal to manage the fund even with few or no outside investors, while also having the conviction that this was a investment product that I thought could be very beneficial to our investment partners over the long term.
Yeah, thanks for that overview. Those first few years, was it mainly kind of blocking and tackling with kind of private investors, high net worth private investors, or were you able to get some larger pools of capital to invest in in those first few years as kind of anchor tenants in the fund?
Yeah, for the first few years, it was primarily high net worth individuals investing in the fund. I did all the marketing on my own, and marketing is not maybe my highest skill set, but I tried to do small things, inform our investors and people interested in the firm on our investment performance. I put out a quarterly letter, which I tried to make both to highlight both our investment process and some companies we were invested in, along with some personal philosophy and my views of both the market and the world. So over time, I was able to build that audience as well. I was fortunate, I guess in 2016, Barron's did an article that on some I guess new funds that had published research on some zero.com, and some of my selections there had done well. So it was had a little blurb in Barron's, and that got a few folks interested as well. And from the early days, it was just myself. In 2016, Nick Bodner interned with me for about a month in Chicago. It was a pretty cramped space to begin with for myself, and then Nick was right by my side. Um, and had a really nice experience with him. Was not able to bring him on at that time just based on our level of assets. But after that, he did a write-up on I think seekingalpha.com highlighting AMREP, and it was one of our larger positions at the time. And actually had a family office reach out to him following the write-up, and he put them in touch with me, and that led to, I guess, a nice relationship with the family office that developed after that, and still one of our investors. And yeah, then I guess on our diligence trips, always tried to reach out with one or two investors on the institutional side. And when I'm in town, just to provide them with an update on how we're doing and who we are. And was fortunate over time have also added, I guess, a nonprofit organization to as one of our larger investors as well. And we have been, I guess, officially closed to new investors since probably 2020, and have actually returned a little capital since then. But overall, very pleased. Our investor base is long-term in nature. I made it a point to meet with everyone, just to develop that personal relationship and highlight to them that microcap companies and microcap investing is much riskier than index investing or large cap investing. And I think it's gone a long way to building their conviction in us and helping provide us with a long-term base of capital so we can successfully execute our strategy as well.
I think you hit on some of this a little bit in your opening remarks, but you focus on sub 500 million in the US and Canada. Your core principles are kind of deep value, research driven, concentrated, long-term, management focused. And I think I kind of like to dive into a few of those areas, but maybe the first one, kind of deep value, you kind of hit on this a little bit already, but you tend to focus on companies that have real assets, kind of old economy businesses. I think you've explained it in a previous interview, not dealing with variable costs, and they can control their own destiny, and their assets that can rise with inflation, things of that nature. And I think you mentioned before that, at least the work that you've done to date at the fund, there's around 250 to 350 of these kind of companies that you've done the work and analysis on, kind of in your sandbox or watch list, if you want to call it that. And I'm curious of these companies. I think one part of deep value is finding kind of companies that have these hidden assets that might not be showing up in the current balance sheet correctly at the right price. And I'm just wondering, like, what percentage of these types of businesses are those companies that the assets aren't being valued properly, and that's kind of the upside to it eventually being unlocked, versus ones where maybe it is, and it's maybe just a function of discovery that re-rates the company higher and finding another institutional investor that thinks it's a little bit more expensive than you. Like, what kind of I'm curious what that breakdown looks like.
Yeah, I'll make sense, and I'll walk. I think maybe the easiest way to answer is maybe walk through our valuation process and our process, and when deciding whether a company should be part of the portfolio, and then address the question kind of on the split between companies that might have something hidden versus something, I guess, that generates value or causes the company to be recognized by other outside investors. But yeah, maybe I'll start with kind of from a philosophical basis. Think of equity market investing as investing in a company and being an owner of the company. So try to take an owner mentality in everything. And despite having kind of a 2-year investment or a 2+ year investment horizon, that's kind of the minimum amount. And I want to be careful or be confident when making an investment that this is a company I want to own personally, regardless of what other investors might pay for it. And so I might not have touched on it before, but it's really an absolute value focus that we have. And not trying to beat any index or outperform any other entity or individual, but trying to generate invest in companies that will provide a payoff if we just own them as if we own the whole thing. So really think of a share as that proportion of ownership of the company. And by doing that, I think what we look for is the generation of free cash flow. And then I think the second part of that is making sure that free cash flow is, for the most part, allocated back to the investors of the firm if there aren't very attractive internal opportunities that the company can reinvest in. And so when going through our research process, as you mentioned, we tend to look at a lot of companies and we model out each one basically by hand, where we input all the historical financials and try to get it down to the segment level, depending on the type of company, to understand the economics of each individual segment, along with corporate, and then build out what we think the company will do in the future in order to produce our own discounted cash flow analysis. And that's really the basis for our intrinsic value. And we tend to use a discount rate that's 12.5%, and have been very careful to keep that consistent through almost all companies. Occasionally we'll make it higher if there's in a particularly, I don't want to say risky, but if we think there are certain attributes of the company that we want a higher discount rate to invest in that, and very rarely make it lower than that. And I think one thing that investors have during periods of poor returns for equity investors, I think one of the biggest things that people might do wrong is lower their discount rate. And by nature, by lowering your discount rate, you're requiring a lower return. And then I think often during those periods, that's what people get. And so try to keep things consistent. I think that's allowed us to be more aggressive in allocating capital when discount rates are particularly high, and less aggressive and more conservative when discount rates are low. But yeah, and through that process, I guess initially if something looks interesting, we'll model it out, reach out to management, ideally have a call with the CFO. Sometimes it might be IR, sometimes it might be the CEO, and really take about 45 minutes to try to understand how the business makes money and operates, the competitive set, how the industry dynamics look. And if it's attractive, we'll I guess I end most conversations by saying we always appreciate the chance to meet people in person. If we're ever in your area, it would be okay for us to stop by and say hello. And it's a hard question to say no to, just how it's framed. And then depending on how attractive the opportunity looks, we'll either make a point to be there within the week or 2 weeks, and otherwise try to tie it in with other travel we might have. And so that's how we calculate intrinsic value. It can be difficult for hidden assets or things that might not be recognized by the market, such as land or buildings or maybe even business lines. But we do our best to estimate what the actual cash flow will be from that asset, if it is something that they're able to monetize, and then make projections on when that might be monetized and utilize our discount rate to bring that back to present value. In addition to that, we utilize a floor value analysis, which is essentially a liquidation analysis of the company. It's not a bankruptcy fire sale type analysis, but it's kind of in a fair and orderly unwind what we think the assets of the company would be worth. And it's pretty punitive for any company that has debt. And other than that, we'll generally value cash at cash, haircut receivables and inventory. And then for property, plant, and equipment, that can vary a lot. And based on cost accounting in the US, most land and buildings are at historical cost, with buildings then being depreciated as well. And there can be a number of situations where those assets were purchased a long time ago, and due to inflation or appreciation, book value might not represent what fair value is today. And then we look to purchase companies at or near what we think the floor value is. And as we look across the portfolio, we then do a direct linear relationship from upside to downside. And so if the stock's $10, we think fair value is 15, it's 50% upside. If we think the floor value is 9.50, we have 5% downside. The ratio is 50% upside, 5% downside. It's a 10. And so that's relatively high, and that would generally indicate that it would be an attractive position for us. Ideally, the company has negative downside, and that can be in situations where we think the market's not assigning correct value. Either it's trading at a big discount to book value, or we think book is dramatically understated for one reason or another. And then we'll look across all of our portfolio companies and look to weight the portfolios of companies with the highest upside to downside ratios, have the highest ratio in the portfolio. And then also on a weekly basis, we compare those ratios to also all companies that are on our watch list, but not currently in the portfolio. And that's really the criteria for getting a company from a watch list to inclusion in the portfolio. And so once we go through the process, a lot of times the company we did research on does not have a ratio that is attractive at that time. And I think investors can have a tendency to want to make place a buy or a sell rating or whatever the equivalent is as soon as you complete the analysis. And I think the best situation is generally to wait. And what we usually wait for is a reduction of the share price to a level where we think we have very little downside and the appropriate upside. I think that's kind of with the value focus of the firm is the patience to wait until the opportunity to invest is much more in our favor than what might have been historically the case. And stocks move, results tend to be volatile, especially for smaller companies. And all investors have different levels of liquidity and risk. So when bad results occur, it can be an overreaction. We look to try to be on the other side of that for companies we've done the work on. So over time have modeled out probably 300 to 400 companies. Not all are up to date, of course, but for most of those, we've got relationships at management relationships at those companies. And if something should come out where either the stock price moves lower or another aspect of the business changes, and we think our upside and downside is might have been still before, but now looks much more attractive, we can generally try to reach out and hop on the phone or get a meeting in place and get up to speed and things updated fairly quickly. And so I think that's been a helpful part of our process as well. In terms of kind of hidden assets, I would think maybe a third of our companies historically have had hidden assets. And I think a lot of times, especially on the land side, people know what the land is, but might not be seeing the same value that we see. and talk maybe about a few land companies later in the portfolio, and Amrip being one of them. But I think a lot of times land would be something that an individual investor really wants to own on their own and is happy to uh, hold things and wait a long time. But uh, for public equity investors, results are volatile. Monetizations are infrequent. And you also have corporate costs that can eat away at the underlying enterprise value between now and when any monetization occurs. So that's an area where we've tended to focus on and have gotten comfort with waiting, where I think a lot of investors might not be more short-term natured, but really not enjoy the volatility and the one-off events that are needed to realize or monetize those assets that can be illiquid during most years. So
How
hopefully
does
that helps with kind of the investment process, and then tying it in to thinking about hidden assets, valuing those, and combining that with just assets on the balance sheet that might be less liquid.
how does a company first come on your radar? I know you do a series of screens pretty readily. I'm guessing 52-week low screens and things like that, but I think there's a few other ones. Like, how's an idea? There's probably not a normal way, but I know that screening is a part of your strategy as well. I'd just be curious to hear more about that.
Yeah, first I should bring up the team there as well. But Nick Bonner, who interned with us in 2016, he came on full time in 2017, and so he's very well connected with a number of investors, and also does his own analysis on things like 52-week lows, insider buys, things like that. Chad Cohorst joined our team as Chief Financial Officer. He's got a lot of chief titles, but he's our compliance officer and also runs our operations. And he joined in 2017 as well. And Harry Sowers interned with us in 2021. He joined full time in 2022, and also a value investing background who did a lot of work even when he was an undergrad on those types of companies. So for me, it's nice to have partners on the team that are focused on identifying and seeking out companies that are of interest. And I think just talking to them, Harry, probably similar ways to screen or identify companies, both from screening and talking to other investors and monitoring 52-week lows and looking out for management buys. So both of those individuals also have their own network of other investors too, that they'll trade ideas with from time to time on other companies we should look at. For me personally, on a weekly basis, I run kind of three major screens. One is a 52-week low screen. Another one is a more typical enterprise value to EBITDA screen with some leverage criteria within that. And then the final one is a property, plant, and equipment to market cap screen. And that one's designed to find, that one's a little less common, I think, but that one's designed to find companies that have historically invested a lot of capital, but in plant and equipment, but that those investments might not be earning an appropriate return today. And in a cyclical market, ideally, or potentially they have the opportunity to do a lot better in a different part of the economic or market cycle. In addition to that, I also try to monitor insider buys. I've got a network of other people that I talk to, try to follow the holdings of certain other investors that I respect, and really go back and a lot of the reasons we look at a company is we looked at the company before, and having the database of companies we've looked at, um, that's really I think a key asset of our firm. And when the share price or something changes internally with the company, then that's kind of the first thing I try to do on a weekly basis. And just with companies we've already explored, if something's changed internally there. And then I'm going through the diligence process. We tend to look at peers or competitors or suppliers or customers, and try to maintain a high level intellectual curiosity. And even if we type in the wrong ticker on something we're trying to do, try to encourage the team to check it out and see if you learn something new by taking a look. But yeah, for me, I guess current database is helpful. Weekly screens, and then monitoring just regular events in the world and what other investors might be doing as ways to identify good companies to look at and learn more about.
Are you fairly active in the portfolio? I mean, kind of below the surface of the underlying companies, as things on a weekly basis get closer or further away to your assessment of intrinsic value, are you shaving some off, adding to them? Is it pretty active, or is it kind of it's either in the portfolio or it's not?
Yeah, I put it in between, and it probably goes to self-discipline and how we think about um, the right time to sell a company. But at a high level, I think it's a good philosophy to sell something when the reason you bought it is gone. And I think that philosophy serves people well, whether it's a car or a house or I don't know, a pen or a phone or anything else. And so when it's lost its purpose for the reason you bought it, then selling it is probably a good idea. Um, with our criteria, with upside versus downside, if we're fortunate and the company we looked at goes or is in the portfolio goes up in value, we tend not to change our valuations much. They can change for two main reasons. Maybe something fundamentally changed with the business, and our estimates of future free cash flow have changed dramatically. But the most common reason that something changes is because they generate cash, and that value that was a discounted future value now becomes cash, which a lot of investors, which is much easier to value than future cash. And so, long-winded way of saying is if a company's stock price goes up and we have not changed our internal valuation, then that company provides us with less upside and more downside. And all else being equal, becomes a less attractive um, holding within our portfolio. And so we're not looking to trim things or move things on a weekly basis, but when there are fairly significant moves, we will look to reduce position sizes in general when they go up. And if a stock price goes down, we try to ensure that it was not due to something outside our expectations, and try to avoid thesis creep and saying, well, our thesis was wrong, but now it's cheaper for another reason. And by doing that, just try to avoid overconfidence and being able to admit when something we thought would happen was incorrect. And if something changes fundamentally that was not what we were expecting, then we'll also, in almost every case, look to sell or reduce our position. If the stock price goes down and nothing fundamentally has changed in our view of the business, then it becomes a much more attractive, or potentially a much more attractive opportunity. So we have kind of by definition more upside and less downside. And so in those cases, we'll look to add or increase our position. So all those can lead to increasing or decreasing position sizes based on their underlying attractiveness versus other companies within the portfolio. And there are also situations, especially with smaller companies, where liquidity can move things higher or lower in fairly rapid order, and try to be able to, again, utilize our long-term nature to either add or decrease position sizing when something um, that isn't related to results might move share prices up or down. So kind of in between, I guess, when it's in the portfolio, it stays there with kind of working to trim or add on a daily basis.
Yeah, I didn't know. You're probably familiar with the fund up in Canada, Turtle Creek, and they're a very kind of active value manager where they're constantly reassessing almost on a daily basis kind of those ratios and their internal IRRs, and they're constantly like adding to things as they even drop 1 or 2%, taking things off as they increase 1 or 2%. So it's a pretty active but long-term strategy, they call it. So I didn't know how active yours was underneath the surface, and how often you're assessing it based on the daily price movements or even weekly. But that makes sense.
Yeah, it'll be less active than that, but something we look at and try to optimize in terms of our portfolio.
Yeah. You mentioned you're concentrated in 15 companies. How much of that is you believe in the principles of concentration versus there's just not enough cheap things in your basket of companies? Like would you see an environment where we had to draw down, the market actually went down 20 or 30 or 40%? Could you see an opportunity? Would you ever flex up the portfolio to 25 names just because there's a lot more, value or deep value in the portfolio of your watch list?
Yeah, I think it's more the former. And what I'll try to do is, from my standpoint, it's very difficult to be based on my capabilities to be knowledgeable on much more than 15 or 20 companies. So we've capped the number of companies that we can invest in at 20 at any one time, and are always trying to work that down. And I think the idea that adding more to your highest conviction name tends to be a much better allocation of capital than investing in your 21st or 22nd best idea. It is challenging during periods of market dislocation. And take kind of the COVID or pandemic when a lot of things were going down, and it's very challenging in an uncertain environment to maybe allocate, or I found it difficult to allocate as much capital as I would like to, and prioritize allocating capital when the liquidity, even of the individual names, might vary dramatically. And so even though something looks attractive, just the nature of smaller companies, you might not be able to add to that position the size you'd like. And in those situations, maybe more of a broader focus might be beneficial. But I think at the end of the day, you might be owning things that again aren't attractive, and balancing the liquidity that the market's providing you during that time with your best ideas, while challenging sticking to a smaller number is best. So yeah, it becomes, I think, anything over 20 is very challenging for me to feel that I'm both knowledgeable enough to be a steward of them in companies, and also from a conviction size, I think adding more to your best is by far better over the long term. So I think that's kind of the right level for us, and then maintaining that discipline. I guess as we've grown some, I think has been important to performance and our portfolio management over the long term.
Given your approach, is it hard to hold for a very long time? I know you're looking at 2 years, and it's funny, if you told people 2 years is your duration, some people would say that's short term, and other people would say that's super long term, right? Like how do you How do you think about that? When I think about your portfolio, I would think that if something really worked for a long period of time, it eventually gets expensive. And so do you re-enter positions? Have you in the past, like in the obviously kind of go up a lot and then come back down, as kind of sentiment shifts in and then back out, in a cycle?
Yeah, I think it varies. Looking at the long term, our average annual turnover has been around 40%. And then equates to kind of a 2.5 year time horizon as our average holding period. And going back to one of our early investments, we initially invested in 2015 and still hold it today. So it's been a 9+ year time horizon. And I think going back to kind of our criteria over a decade of work, the company's been able to generate a significant amount of cash, both through its regular operations. Just as background, the company owns 17,000 acres of land in Rio Rancho, New Mexico, which is a suburb of Albuquerque. It's owned the land for a long time. A lot of mediocre to poor land holdings. It goes back to kind of the founding of the community. Amrit founded it and bought, call it 90,000 acres, and then checkerboarded it out, marketed to a lot of East Coast investors in the late 70s and early 80s as a vacation spot. Probably overpromised on some of the attractiveness features, but going to today, it created a community with a lot of owners that weren't living in the community, and made it difficult to commingle that into lots that could be developed in subdivisions that made the economics attractive. And so, as the largest owner, they've done a lot of work in aggregating those and putting them into large enough parcels where initially they would sell to home builders. In 2021, the company started its own home building subsidiary, which provided both another outlet for its land sales, kept the home builders honest, and also the opportunity to develop single or smaller lot pad sizes, not pad sizes, but call it 12 to 15 lot pads that most home builders isn't worth their time to do the work on. And yeah, over I guess almost 10 years, they hired a new CEO. When I first started looking at them, they had kind of a three co-chairmen managing the company. They bought back almost 30% of outstanding shares, still have a cash balance north of $40 million. And at one time, I guess in 2020, it was by far our largest position. It was almost 20% of our fund. At that time, I think the company had a market cap of $40 million or so, 10 million of net cash, and for $30 million, you were buying 17,000 acres of land, a number of I guess subdivision type sites along with some commercial land. And yeah, I guess your earlier question on valuation, we thought at under $1,000 an acre, I think it was at the time, it was very attractive, and that's on a weighted average basis. But over time, as I think the market's growing more comfortable in terms of what cash flow the company's actually generated and how they deployed that capital, investing in new communities where it made sense, internally developing a home building subsidiary, and also buying back several large blocks of shares from investors that were looking to exit. They showed that from a capital allocation standpoint that they were doing a great job. So that's been something that as cash has continued to grow, share count has come down, that it continued to be attractive for us. But yeah, there are other situations, I guess, where we're fortunate enough that the stock price might move up and in a shorter time period, and no longer looks as attractive both on a standalone basis and versus other companies we're looking at. That if we're fortunate in that situation, it'll be something that we look to exit. We do take tax implications into consideration as well, but try to combine, um, take all that into account, and if something's moved positively in a short amount of time, yeah, we'll look to exit. And yeah, these companies' share prices tend to be volatile. We no longer own it, but Geospace Technologies was a company we were investors in for some time. Probably exited in 2021, and subsequent to that, I want to say in late 2022, the stock price collapsed, and we were able to establish, I think we're around 15% of that and company when the stock price was $5.50. And so I think it was year end and probably some tax loss selling, but we were pretty aggressive there when we thought there was limited downside and significant upside. They, just as a background, are Houston-based company focused on the energy market, have developed their own seismic technology that was originally done for evaluating whether there was oil or natural gas in a particular reservoir, and that's expanded over time. They have an industrial business now, and they have also done work on border security with a lot of that seismic technology. But the energy market shifted in 2022 and 2023, and they were able to generate a good amount of cash, especially from their rental fleet of offshore oil and gas seismic equipment. And so as perception changed there, and the company generated some cash, I think the market provided a higher valuation. And based on, I guess, our prior ownership, we'd grown comfortable in when things were looking rough, that the company's prospects were not as dim as others had expected.
You mentioned you were focused on management, and I think I know the answer to this, but if you kind of drew two intersecting lines, one being microcap and one being deep value, it's probably where the most activism is as well, from large holders trying to force management to unlock value. But you seem to be one that is trying to find management teams that are already sort of doing the right things. But I'm also curious if you ever have gone activist in a situation, or do you see that being part of your strategy?
Yeah, it's not an active part of our strategy. We look to invest in companies where we think there's good alignment with management, and we're confident in management's skills and abilities and their ability to allocate capital. We filed a handful of 13Ds over time. In those situations, wanted to kind of protect ourselves, as we've always tended to provide management teams with ideas in terms of what we think best practices are, and be helpful as we are active investors and partners with them in the business. On occasion, where we might have an idea that we think could really help maybe the valuation discount that we see in the market, we filed a handful of 13Ds and try to still keep all of our work there out of the limelight, and maintain a good supportive relationship of management teams. So it's something we've looked at on occasion, but going back, kind of having those strong management relationships are a really important part of our process, and have been hesitant to give management teams any reason to not talk to us. And I've tried always to be a good partner in whether we are a big or small investor in each company we invest in.
You mentioned your kind of three qualitative attributes you look for. I think they were intelligence, integrity, and work ethic. Could you go in a little bit more detail, and how do you identify those, or figure out if the management has all three?
Yeah, it's interesting. I'll take a kind of a step back, but typically when we meet with management, we'd like to have at least two people on our team with us in those meetings. And I think a critique of management meetings is that management tends to market to investors, and highlight the good things and not the bad things. I think by having two people at any meeting, you're able to get two different views on how people answered questions, how they behaved, kind of different situations, and uh, in meetings where there might be multiple members of the management team there, always encourage the person not asking the question. You can have the tendency to kind of tune out when it's not your question, but try to stay focused both on how the person's answering the question and then also how their colleague is reacting to how they're answering the question, as you can get different verbal and nonverbal cues in terms of how people are reacting. But um, uh, in regards to kind of how we come out, it's interesting, but typically we're in agreement as a group, and I'd say very rarely do we have different views on whether someone meets those qualifications or not. Intelligence, you look for an understanding of the business, the competitive dynamics. On work ethic, kind of a similar thing, but also looking for, I guess, how management interacts at headquarters, whether it be with other employees or other people on the floor, how well they know the facilities, if we were given the opportunity to have a tour, um, and and kind of how they treat people and maybe the pride they take in their work. From an integrity standpoint, that's more intangible, but tend to gravitate towards managers that um, are not promotional, that provide a level analysis of both the positives and negatives, that might not be as worried about their share price as others. And I think an alignment of incentives is always helpful there as well. And so we like to see management teams with skin in the game, obviously, and I think that creates a good alignment. But seeing, I guess, and understanding how, or trying to understand how management teams might um, utilize their incentives to further the company or invest internally in the company or manage the company. So it's not consistent across all companies, and every company is managed differently and incentivized differently. But understanding what those incentives are and then maybe how management is managing to meet those incentives, I think is helpful in evaluating their integrity as well.
How often have you visited a company at their headquarters and you were going into the meeting thinking, yeah, this is something we could probably buy at the right price. And then after meeting the people or seeing the assets, this is definitely a no. This is not something. How often is it that black or white? The company visit being an influence on a buy decision.
Yeah, it's in 10 or 15%. And there might be a definite no. And there are managers, I guess, who, based on the meeting, that I don't have conviction that they'll act in the best interest of shareholders. There are also situations, I think, with the visits, it's really helpful, maybe not so much from an upside standpoint, but from a downside standpoint. And so there are situations where a property might look good on Google Maps or something else, but by visiting, we come to the view that our downside is not protected as we thought based on what we think the secondary market value of that real estate is. And so in some cases, buildings have been much more in a dilapidated type situation than we thought going in. And in that case, the downside that we're assessing has fallen much more than what we might have initially anticipated. So it's a small amount of times, but I'd say kind of the 10 to 15% range, based on that meeting that it's a company that's not going to be a fit for us.
Now that the fund's been up and running for 10 years, what what's been an area that you think you've evolved and gotten better in, now looking back 5, 6 years even?
Yeah, I think one asset that's really grown is our network of companies that we've invested in and modeled and analyzed and have relationships on. So that continues to expand, I think, is a unique asset that only grows over time. I think just going back to in terms of evolving uh, and maybe turning the qualitative analysis of management to a more quantitative analysis. And so the upside and downside, it's a very quantitative methodology. And both for understanding if a company should be in the portfolio, but also um, how it should be weighted. And it can be interesting, kind of, I think, in an analysis of Gate City as well. Does why meet with management then if it's all quantitative? How do you kind of intersect the qualitative aspects of management meetings with quantitative? And I mentioned it with downside analysis, and by being there, you can gain more comfort or less comfort in the underlying assets. But I think a unique part of the DCF that maybe has evolved a little bit for me is the conviction that the cash that the company generates is actually the shareholders' cash. Um, so traditional DCF, you model out cash flows, you have the number of shares outstanding. But I think making sure that there are not ways for management to allocate a disproportionate share of those cash flows to themselves or people outside of other shareholders is an important part as well. So probably where I've evolved and where I think personally, maybe I've on investments that haven't worked as well, it's been in situations where the cash that we think is going to flow to investors actually goes somewhere else. And so taking that aspect and being confident in the management team and the ratable allocation of those cash flows is one other aspect that combines the qualitative and quantitative parts of our analysis into really being a very helpful piece of our upside and downside analysis.
Now when it was just you the first 3 years, it was just you, making all the decisions, doing all the research. Then I think Nick joined you, like you said, in 16, full-time in 17. I think Harry joined you, in the last 2 years. You have 2 research analysts now at the firm. Like talk a little bit about the scaling of a research organization like yours. You doing all the work to now you have 2 other people. How do you delegate those roles? How do they work with you as a PM now?
Yeah, and I think a big aspect of that too, and I'll touch on just the back office is it when it was only me, it was a whole lot of work just doing the research, managing the portfolio, but also handling a lot of the aspects of running a business. And I found it important just in bringing on Chad. He's someone who was actually my college roommate, and so an accountant by background with Big Four experience and fund accounting experience. Found it very important to have someone that I could trust deeply with very sensitive information, and having the conviction there that things would be done right allowed me to focus on much more of my time on the investing process. And yeah, I think from an expansion of the team standpoint, it's something that I put a lot of thought into. I think we always want a small team. And both Nick and Harry interned with me before investing. And I think we've been fortunate thus far to have no turnover at the firm, which I think can be very disruptive. But I've tried to, rather than bring in people that trying to teach the research process to, both Nick and Harry deep value, microcap focused research process going in. And so rather than trying to inspire them that this process was best, always had a situation where this is what they wanted to do on their own. And this is what they found exciting and personally and professionally motivating. And what I've tried to do is provide them with the opportunity to do their best research analysis work here and provide them with the opportunities that allow them to be the best um, research analysts they could be. In terms of allocating work, there are, I guess, no definitive lines in terms of we'll work on this or you'll work on that. I try to provide people with the flexibility when they find an idea they think is interesting to pursue that as long as they want, and the resources that they want to travel or do other things in the research process to better understand the opportunity. Um, but we'll have certain sectors where people have taken the lead on. Nick's done a lot of work on the media space, a fair amount of work on the retail space, and has been also active in land development type companies. Harry's done a lot of work on the natural resource space. Going to let our research process on offshore energy, a lot of energy service companies, and a lot of other commodity-based companies as well. And so if there's an area that an individual's developed an expertise in, try to allow them to utilize those skills and focus on other companies that might come up there. But overall, everyone on the team has a big part of their net worth invested in the fund. We all sit very close together, and I try to make it as collaborative as possible in terms of both idea generation and allowing people to express disagreements with conclusions or analysis. And in terms of when we make an investment decision, we generally put together a 2-page write-up with the risks, potential upside and potential downside, and then do the devil's advocate session is try to make sure that everyone's comfortable with the analysis that's put forth and all the risks that can be identified are identified. So going back to your question, have tried to give people the independence to pursue ideas they want with a recognition that they've developed certain specialties just by the work they've done historically, but also allow everyone to interact as those ideas are explored. From a personal standpoint, it's provided me the opportunity, I guess, to focus on maybe a smaller subset of companies where I'm really the lead analyst on, which I think has been helpful. And it's also, I think, from a portfolio manager standpoint, it's I guess required me to be a little bit more in the monitoring and management role as research is conducted versus being the point person on every single company. And so there's a level of trust and faith that's been built up on the team over time that I can have conviction that they're doing very strong work. And while I'm still the ultimate decision maker on each one, no longer have to be the main research analyst as well, which has allowed me to focus and also utilize the good work that Chad, Nick, and Harry have done in order to look at more companies and find and ideally optimize the quality of our portfolio.
Are there any tools or resources or subscriptions that you use as a firm that you find additive to your strategy?
Very little. We have a soft rule is we really try not to subscribe to any outside services. And it kind of goes back to, so no street research. I guess we'll look at stuff if something's passed on to us, but no subscriptions there. We have a screening tool that we use that's a subscription service, but I guess over time have relationships across a number of platforms, including your own, that we utilize to gather ideas and information, but try to make it all our own work, no expert networks or things like that as we go about our research process, and really don't want to be influenced by too many others as we're going about our diligence process, and try to stay as independent as possible as we do that.
One of the last questions that I have is something I think also makes you unique. That I think you've closed the fund since 2020. You've given back capital, I think, a couple of times, since then. It's really a decision to keep your AUM smaller than it could be, which I think is rare when it comes to fund management. Maybe talk a little bit about why that is the case, and also, as explained, why to that. How do you balance kind of staying small and being disciplined with evolving and growing, as a firm?
Yeah, it's something I put a lot of thought into, and it's very difficult to quantify the exact pros and cons of growing in size. And it's at the end of the day, it's a good problem to have. And I guess when thinking about our investment process, I think where we've been able to deliver some good absolute returns for our investors over a decent period of time. It's by staying true to the original investment process of concentrated microcap value. And so I don't want to grow assets to a point where we put those advantages and that process at risk. In growing over time, it does, and I think it's a reason why not a whole lot of investors, especially larger ones, focus on microcap. It's not worth their time based on the assets that they have under management to do the work that's I think necessary to typically do a good job. And so that's, I think, one of the advantages. And as you grow, I think there are three kind of things you can do. You can either take larger positions in similarly sized companies, you can take on more positions, or you can increase the size of companies you invest in. And going back to kind of our conversations on concentration, I think that's something where I don't want to compromise. So over time, we've been larger owners of individual companies. And I think when doing that, the liquidity issues that are prevalent in microcap investing become more prevalent. And the conviction level you need when it's pretty apparent that it'll be very tough to exit in normal circumstances, that you really want to be a long-term owner of that business. We have invested in a few companies that are above 500 million in market capitalization. And so those are situations where we're able to go through our entire due diligence process, meeting with management, touring facilities, and where we think there are aspects of business that are underappreciated, and we're deciding not to limit ourselves and avoid opportunities just because of a market cap number. But taking all that together, have tried to manage the growth of the firm where it does not put our advantages at risk, and do so in a way that allows us to continue to reward our investors with, I think, for most of them, a desire to stay invested with a thought on, well, if we grow, kind of what could that do to our performance over the long term? There's no formal equation on that, it's difficult to calculate, but I've tried to do my best to keep things at a manageable level where our process continues to be effective and can be for the long term, and rewards both our investors and our internal partners here with growth from doing a good job with not putting our original investment process and thesis behind the firm at risk as well.
I think thanks for sharing with that. I often think about there's few people that have been as successful as you are, especially in deep value. And I often think about the biblical parable of the talents, and you've obviously stewarded capital very well with the little amount that you've been given. And think about, I'm sure you've looked upstream and think, okay, can we duplicate our process, in that 500 million to $1.5 billion kind of range of company? Maybe it's a separate vehicle. And yeah, we're not going to do a 22% net CAGR over 13 years or whatever, but hey, 17% still beats everybody else, and it's still making a lot of value for our investors too. So I know I was just curious if you've ever done that work up into the kind of the upper band of market cap and small cap, and if it's duplicable or not. And I'm sure it's something you think about more than me, but something that I was curious your thoughts on. So thanks for sharing that.
Yeah, I think the thing I'd add too is that both Nick and Harry and myself have been focused on this area in personal interest from a pretty young age. And I think we're all very intellectually excited about continuing the work there. So I think that's been a helpful thing as well. I think there can be a tendency for other investors, if they're interested in multiple aspects of the market, to want to grow that and expand. But I think with our internal focus on that area of the market from relatively young ages, that provides a lot of incentive to continue working on that versus navigating to other areas of the market. And the other questions asked as well as geographically, as you mentioned, almost all of our investments are in the U.S. with an occasional focus in Canada. And can this be done internationally? And I think just the culture and accounting, it varies so much, even in Canada, and much more if you go overseas, that there's a ripe opportunity set here in the United States, and that's where we want to stay focused over the long term as well.
Excellent. Well, thanks for the time today. Really appreciate you diving into the strategy and telling us more about your process. Thank you.
Yeah, amazing. Thanks for having me. It's always fun to chat, and still a whole lot of work to do. So I appreciate the kind words, but we're all relatively young and motivated, and this is what we want to do. So are pleased with how things have gone so far, but focused on the future. And yeah, I would encourage anyone that wants to reach out. Feel free to. I try to be open to new ideas and new relationships, and expanding both my contacts and knowledge of companies that other people might think of, or if people have any critiques on the companies we're invested in, or suggestions on how we can learn more. Always try to stay open intellectually to doing the best we can do. So very much appreciate the relationship that we've had over the years, Ian, as well. And thanks for all your support over time. And it means a lot to me. So just want to say thank you, and would welcome any questions or comments that the audience might have. Feel free to reach out.
Okay. Thank you. Thanks, Michael. Thanks, everyone.
Hey, thank you.
Take care.